Hey everyone, welcome back to Crypto Tax Australia. Today we're covering two of the most common ways Australians are earning crypto outside of just buying and selling, and two of the most misunderstood when it comes to tax time. Staking rewards and airdrops. A lot of people treat these as free money, tokens that just land in your wallet without you doing much. And because of that, a lot of people assume they don't need to worry about tax until they sell them. That assumption is wrong, and it's the kind of mistake that can turn a nice passive income stream into an unexpected tax bill. So today we're going to break down exactly how the ATO taxes staking rewards and airdrops in 2026, when the tax event happens, how to calculate what you owe, and what happens when you eventually sell those tokens down the track. Let's get into it. Before we dive into staking and airdrops separately, I want to establish one principle that applies to both. Because once you understand this, everything else clicks into place. With most crypto you buy, there's only one tax event: when you dispose of it. You buy Bitcoin, you sell Bitcoin, you calculate your capital gain or loss. Simple. But with staking rewards and airdrops, there are potentially two tax events. Event 1, when you receive the tokens. This is typically treated as ordinary income at the AUD market value on the day you receive them. Event 2, when you dispose of those tokens later. This is a capital gains event, just like any other disposal. So you pay income tax when you receive them, and then CGT when you eventually sell or swap them. The cost base for that second event is the value you already declared as income. So you're not taxed twice on the same amount, but you are taxed twice as two separate events. Keep that two-event framework in mind as we go through each topic. Let's start with staking. Proof of stake staking is where you lock up crypto, ETH, SOL, ADA, whatever, to help validate transactions on the network, and in return you earn rewards in that same crypto over time. So how does the ATO treat those rewards? The ATO's position is that staking rewards are ordinary income at the time you receive them. The amount of income is the AUD market value of the tokens on the day they hit your wallet. So if you receive 0.1 ETH as a staking reward on a day when ETH is worth $5,000 AUD, you've received $500 of ordinary income. That $500 gets added to your taxable income for that financial year, alongside your salary, your business income, and anything else. And this happens every time you receive a reward. If you're staking and receiving rewards daily or weekly, each one of those is a separate income event with its own AUD value on that date. This is exactly why record keeping for staking is so important, and why doing it manually is a nightmare. Now here's the second tax event. When you eventually sell or swap those staking rewards, a CGT event is triggered. Your cost base for CGT purposes is the AUD value you already declared as income. So if you declared $500 income when you received that 0.1 ETH, your cost base is $500. If ETH goes up and you later sell that 0.1 ETH for $800, your capital gain is $300, not $800. And the 12-month CGT discount applies here too. If you hold those staking rewards for more than 12 months after receiving them before selling, you may only pay tax on half the capital gain. What about staking through an exchange? Same rules apply. Whether you're staking directly on-chain or through a platform like Coinbase or an Australian exchange, the ATO treats the rewards as income at the time of receipt. The platform doesn't change the tax treatment. Let me run through a few questions I see come up constantly on staking. What if I can't access my rewards until the lockup period ends? This is a genuine gray area. The ATO's general position is that income is accessible when you have the ability to access and use it. If your rewards are locked and you genuinely cannot access them, a reasonable argument exists that the income event occurs when the lockup ends and the tokens are available to you, not when they accrue. This is one for your tax agent to advise on specifically because the facts of your staking arrangement matter. What if the token I'm staking crashes in value after I declare the income? This is unfortunately a painful but real scenario. You declare the income at the AUD value when received. If the token then drops significantly before you sell, you'll have a capital loss when you eventually dispose of it, which can offset other gains. But you've still paid income tax on the original receipt value. This is one of the trickier aspects of crypto income taxation, and it's a strong argument for keeping detailed records and reviewing your position before June 30th each year. Does the 50% CGT discount apply to staking rewards? Yes, but the 12-month clock starts from the date you received the reward, not from when you first staked your original tokens. So rewards you received more than 12 months ago are eligible for the discount when you sell them. Rewards received in the last 12 months are not. Now let's talk about airdrops. And this is where it gets a little more nuanced, because not all airdrops are the same. An airdrop is when tokens are sent to your wallet, usually for free, either as a promotional distribution, a reward for holding another token, or as part of a new project launch. The ATO's position on airdrops depends on the circumstances of how you received them. Scenario 1. You received the airdrop because you held another token or met some criteria. This is the most common type. You held a certain token, a new project airdropped tokens to all holders, and they landed in your wallet. The ATO is likely to treat this as ordinary income at the AUD market value on the date you received them. Same as staking rewards. Declare the income, establish a cost base, pay CGT later when you dispose. Scenario 2. Unsolicited airdrop. Tokens sent to you with no action on your part. If tokens are sent to your wallet completely out of nowhere and you had no expectation of receiving them and took no steps to receive them, the ATO may consider this to have a cost base of 0 rather than being treated as income. The tax event then occurs entirely at the point of disposal, and your entire proceeds become the capital gain. This is actually a less favorable outcome in many cases, so it's worth understanding the difference. Scenario 3. Airdrop received in exchange for something, like completing tasks, providing data, or participating in a protocol. If you did something to receive the airdrop, signed up, completed actions, participated in a testnet, the ATO may treat this as income for services rendered, similar to employment income. The full AUD value at receipt is assessable income. The practical challenge with airdrops. Here's the honest reality. A lot of airdrop tokens are worthless or near worthless at the time of receipt. If you receive 10,000 tokens of a brand new project worth $0.01 each, your assessable income is $10. Not a big deal, but if that project explodes and those tokens are later worth $5 each, your capital gain on disposal is calculated from that $10 cost base, meaning almost the entire $50,000 proceeds is a capital gain. This is why tracking every airdrop, even tiny ones, matters. And it's also why some people choose to dispose of low-value airdrop tokens quickly, rather than holding them as a speculative position, simplifying the tax treatment. What about airdrop tokens you never asked for and can't sell? If tokens are genuinely unsellable, on a chain you can't access, with no market or locked permanently, a reasonable argument exists that there's no assessable income because there's no realizable value. Document everything and discuss with your tax agent. I want to spend a moment on record keeping specifically for these two income types because it's more complex than tracking regular buy and sell transactions. For staking rewards, you need to record the date each reward was received, the amount of tokens received, the AUD value of those tokens on that date, the platform or protocol you are staking through. If you're receiving rewards daily or weekly across multiple assets, that's potentially hundreds of income events per year. This is where a tool like Coinly genuinely earns its keep. It can pull staking reward history from supported protocols and exchanges and calculate the AUD value at the time of each receipt automatically. For airdrops, you need to record the date the tokens arrived in your wallet, the amount received, the AUD value on that date, even if it's tiny, the reason you received them, unsolicited, held a qualifying token, completed tasks. That last point matters because the reason affects the tax treatment, as we covered. If you're ever reviewed by the ATO, being able to explain why you received an airdrop and how you classified it is important. The ATO expects records to be kept for at least 5 years from the date you lodge your return for that year. For staking an airdrop specifically, that means going back and capturing historical data if you haven't been tracking properly. Let me quickly run through 3 real-world scenarios to bring this all together. Scenario A. Regular ETH staker. You stake ETH and receive $1,200 worth of staking rewards across the financial year. That $1,200 is added to your taxable income. When you later sell those rewards, you calculate CGT from the $1,200 cost base. If you hold each reward parcel for over 12 months, the 50% discount may apply. Scenario B. Token holder who received an airdrop. You held SOL when a new project airdropped tokens to all SOL holders. On the day of the airdrop, the tokens were worth $300. You declare $300 as income. 2 years later, you sell those tokens for $4,000. Your capital gain is $3,700, and because you held for over 12 months, you may only pay tax on $118.50 after the 50% discount. Scenario C. Completely unsolicited airdrop. Random tokens worth $5 appear in your wallet. You did nothing to receive them. Cost base is likely 0. You hold them for 14 months and sell for $200. Your entire $200 is a capital gain, but the 50% discount applies, so you're taxed on $100. So to wrap up, staking rewards and airdrops are not free money from a tax perspective. They're almost always income events at the time of receipt, followed by a CGT event when you eventually dispose of them. The 2-event framework is the key thing to remember. The earlier you start tracking these properly, the better. Every staking reward and every airdrop needs a date, an amount, and an AUD value recorded. If you've been letting these pile up untracked, now is the time to sort it out, ideally before June 30th. If you want to see how to pull all of this together in Coinly, I can create a full Coinly walkthrough on screen in the next video. The affiliate link is in the description if you want to sign up free. Drop your questions in the comments below. especially if you've got a specific staking or airdrop scenario you're unsure about. I genuinely read everyone, and it helps me plan future videos. Subscribe if you haven't already, like the video if it helped, and I'll see you in the next one.